Global debt is often discussed as a number so large it feels meaningless. Trillions upon trillions of dollars move across balance sheets. Headlines announce new records every year, and yet very few people ever stop to ask the most important question of all: who actually owns this debt? Because debt is never just an abstract figure. Every liability exists because someone else holds an asset. And when you follow that trail carefully, a far more unsettling picture of the global financial system begins to emerge. At its core, global debt represents promises. Governments promise to repay bondholders. Corporations promise to repay lenders. Households promise to repay banks. The total value of these promises now exceeds the size of the entire global economy by a wide margin. But these promises are not evenly distributed. Some countries owe enormous sums. Some institutions hold enormous claims. And power in the modern world increasingly flows not from production or labor, but from ownership of debt itself. To understand who really owns the world's liabilities, it is necessary to begin with governments. Sovereign debt makes up a massive share of global borrowing. The United States alone has accumulated debt larger than its entire annual economic output. Japan's government debt is even larger relative to its economy. Across Europe, emerging markets, and developing nations, borrowing has become a permanent feature of governance. Governments no longer borrow for emergencies alone. They borrow to function. But governments do not borrow from thin air. They borrow from bondholders. These bondholders include domestic investors such as pension funds, insurance companies, and banks. They also include foreign governments and global financial institutions. In the case of the United States, a significant portion of Treasury debt is held abroad, particularly by countries that run large trade surpluses. For decades, nations like China and Japan accumulated U.S. debt as a way to recycle export earnings and stabilize their currencies. This arrangement created a delicate balance. The United States consumed more than it produced, financed by borrowing. Exporting nations produced more than they consumed, storing excess savings in U.S. government bonds. On paper, everyone benefited. In reality, this structure concentrated risk and power in ways few fully understood. When a country owns another country's debt, influence follows. Not necessarily through overt control, but through dependency. Debtors must maintain stability to keep lenders confident. Credit ratings, interest rates, and investor sentiment become invisible governors of national policy. Fiscal decisions are no longer made in isolation. They are made with markets watching closely. Beyond governments, corporations are now some of the largest borrowers in the world. In the years following the global financial crisis, interest rates were pushed to historic lows. Cheap money flooded markets. Corporations borrowed aggressively, not only to invest in productivity, but to buy back shares, acquire competitors, and boost short-term stock prices. Corporate debt exploded quietly, often hidden behind strong earnings reports and rising equity markets. Who owns this corporate debt? Once again, the answer leads back to large financial institutions. Asset managers, hedge funds, pension funds, and insurance companies dominate corporate bond markets. A relatively small group of global investment firms now controls vast portions of the world's financial claims. Through index funds and bond portfolios, they hold stakes in thousands of companies simultaneously. This creates a system where ownership is dispersed in theory, but concentrated in practice. Household debt completes the triangle. Mortgages, student loans, auto loans, and credit cards represent obligations carried by ordinary people. These debts are often portrayed as personal responsibility issues, but they are deeply embedded in the global financial system. Household debt is packaged, securitized, and sold just like government and corporate debt. What begins as a family mortgage often ends up as part of a global investment portfolio. This means the financial health of everyday households directly supports the asset values of global investors. When households struggle, defaults rise. When defaults rise, asset prices fall. And when asset prices fall, central banks and governments intervene to stabilize markets. This cycle reveals a hidden truth. The system is designed to protect debt ownership more aggressively than debtors themselves. Another critical layer of global debt ownership lies within the banking system. Banks create money through lending. Every loan becomes an asset for the bank and a liability for the borrower. This process expands the money supply and the debt supply simultaneously. While banks appear as intermediaries, They also hold enormous power because they control access to credit itself. Their balance sheets are deeply intertwined with governments, corporations, and households all at once. Central banks sit at the center of this structure. Through asset purchases, emergency lending programs, and liquidity facilities, central banks have become major holders of government and private debt. In times of crisis, they step in as buyers of last resort. This stabilizes markets, but also blurs the line between public and private finance. Debt that was once held by markets increasingly sits on central bank balance sheets. This raises a profound question about ownership. When a central bank holds government debt, does the government owe itself? In theory, interest payments cycle back into the public sector. In practice, the discipline imposed by markets weakens, encouraging further borrowing. Debt becomes easier to issue, harder to unwind, and politically dangerous to confront. Globally, developing nations face the harshest consequences of this system. Many borrow in foreign currencies, exposing them to exchange rate risk. Their debt is often held by international lenders with little tolerance for instability. When conditions deteriorate, capital flees, currencies collapse, and debt burdens explode. Ownership of debt in these cases translates directly into leverage over economic policy and national sovereignty. As global debt continues to rise, ownership becomes increasingly concentrated. The same institutions often hold government bonds, corporate debt, and household-backed securities simultaneously. This concentration reduces resilience. A shock in one area quickly transmits across the entire system. What appears diversified is, in reality, deeply interconnected. The world's liabilities are not evenly owned by the world's people. They are owned disproportionately by financial institutions, sovereign investors, and asset managers whose primary obligation is not social stability, but return on capital. This reality shapes policy decisions, crisis responses, and the future of economic growth itself. Global debt is not just about how much is owed. It is about who holds the claims, who sets the terms, and who bears the consequences when promises cannot be kept. And this is only the first layer of a much deeper story. As global debt continues to expand, the true implications of who owns it become impossible to ignore. Debt ownership is not passive. It shapes power, determines stability, and quietly decides who absorbs pain when economic systems are stressed. The modern financial world is structured so that risk appears distributed, but consequences remain deeply unequal. One of the most important yet least discussed realities of global debt ownership is how it influences policy before crises even occur. Governments that rely heavily on borrowing must constantly reassure creditors. Budget decisions are framed around market confidence. Interest rate expectations influence political choices. Even social spending becomes constrained by the need to maintain favorable borrowing conditions. This means that debt holders indirectly influence national priorities without ever appearing on a ballot. As debt levels rise, refinancing replaces repayment. Governments roll over existing obligations rather than eliminating them. Corporations issue new bonds to service old ones. Households extend loan terms to manage monthly payments. This system functions smoothly only as long as confidence remains intact. The moment trust weakens, the cost of debt rises rapidly, and stability begins to fracture. Those who own the debt are positioned to withstand these shocks far better than those who owe it. Large financial institutions diversify across regions and asset classes. Losses in one area are often offset by gains in another. Meanwhile, debtors face fixed obligations regardless of economic conditions. When income falls or costs rise, the pressure becomes immediate and personal. This imbalance becomes most visible during crises. When markets seize up, governments and central banks intervene to protect financial stability. Liquidity is injected. Asset prices are supported. Credit flows are restored. These actions are often justified as necessary to protect the broader economy, but their primary effect is to preserve the value of debt held by major institutions. For ordinary people, the experience is very different. Wages are slow to recover. Job losses linger. Asset ownership remains out of reach. The burden of adjustment falls on those least able to absorb it. Debt ownership insulates capital while exposing labor. Another consequence of concentrated debt ownership is the suppression of long-term growth. When too much income is diverted towards servicing debt, less remains for productive investment. Governments spend more on interest and less on infrastructure. Corporations prioritize financial engineering over innovation. Households delay family formation, home ownership, and entrepreneurship. This creates a self-reinforcing cycle. Weak growth encourages further borrowing to maintain living standards. Further borrowing increases debt burdens. Higher debt burdens reduce future flexibility. Over time, the system becomes increasingly fragile, dependent on low interest rates and constant intervention. Central banks are now deeply entangled in this cycle. Their balance sheets hold massive quantities of government and private debt. They are expected to stabilize markets, control inflation, support employment, and maintain financial confidence simultaneously. These goals often conflict. Raising interest rates to fight inflation increases debt servicing costs. Lowering rates to support growth encourages further borrowing. Debt ownership limits policy choices. The larger the debt, the narrower the path forward. Sudden adjustments risk destabilizing the system. Gradual adjustments risk prolonging imbalances. In both cases, those who hold debt have far more protection than those who owe it. Internationally, the dynamics are even more severe. Countries that lack reserve currencies face strict discipline from creditors. When borrowing costs rise, they must cut spending, raise taxes, or seek external assistance. These measures often trigger social unrest and political instability. Debt ownership becomes a mechanism of control rather than cooperation. At the global level, institutions such as international lenders and large asset managers play an outsized role. Their decisions influence capital flows across continents. A shift in sentiment can drain resources from entire regions overnight. The people affected have no influence over these decisions, yet they bear the consequences directly. As debt accumulates, the idea of repayment becomes increasingly abstract. Much of the global system now assumes perpetual refinancing rather than resolution. This works only as long as confidence holds. The greatest risk is not default itself, but a sudden loss of belief in the system's ability to sustain the illusion. When that belief breaks, ownership matters more than ever. Those with claims demand protection. Those with obligations face adjustment. History shows that in such moments, policy choices tend to favor stability of financial structures over fairness of outcomes. The question of who owns the world's liabilities is therefore inseparable from the question of who shapes its future. Debt ownership determines which voices are heard during crises and which are ignored. It influences whose losses are absorbed and whose are avoided. It defines the boundaries of economic possibility. Global debt is often framed as a technical issue, a matter for economists and policymakers. In reality, it is a social and political issue with profound consequences. The structure of debt ownership reinforces inequality, concentrates power, and limits collective choices. As the world moves deeper into an era of high debt and low resilience, these dynamics will become harder to manage. Growth alone cannot resolve them. Inflation cannot erase them without consequences. Default cannot eliminate them without disruption. The system persists because it has not yet been forced to fully confront its own contradictions. But pressure is building, and when adjustment finally comes, it will reveal a truth that has always been present beneath the surface. Debt is never just about money. It is about power, obligation, and who ultimately pays the price. As the weight of global debt continues to grow, the final question becomes unavoidable. How long can a system survive when ownership of obligations is so concentrated and responsibility for repayment is so widely dispersed? History suggests that systems built on imbalance rarely correct themselves gently. Debt does not disappear on its own. It must be repaid, inflated away, restructured, or defaulted upon. Each path carries consequences, and none are painless. Inflation reduces the real value of debt, but erodes purchasing power and trust in currency. Restructuring protects stability but shifts losses quietly onto savers and institutions. Default resets balance sheets but shatters confidence and can destabilize entire societies. The reason global debt has reached its current scale is not ignorance, but delay. Each generation of policymakers has chosen stability today over adjustment tomorrow. Borrowing has replaced reform. Liquidity has replaced discipline. And debt ownership has ensured that the cost of delay is pushed downward rather than upward. Those who hold the claims are insulated by diversification, influence, and access to emergency support. Those who owe the debt remain exposed to fixed obligations regardless of conditions. This imbalance shapes behavior across the economy. Risk-taking is rewarded. Caution is penalized. Saving becomes difficult. Dependency becomes normal. As debt grows larger than the productive capacity of economies, it changes the nature of growth itself. Expansion no longer comes from innovation or efficiency, but from leverage. Asset prices rise faster than incomes. Wealth concentrates while mobility declines. This is not a temporary phase, but a structural outcome of debt-driven systems. The longer this structure persists, the more fragile it becomes. Small shocks grow into systemic threats. Interest rate changes ripple across markets instantly. Confidence becomes the most valuable asset and the most unstable one. When belief falters, even briefly, the consequences are amplified. Global coordination makes adjustment harder, not easier. No nation wants to move first. Tightening policy risks capital flight. Loosening policy risks inflation. The system becomes locked in place, held together by expectation rather than strength. Debt ownership also shapes narratives. Crises are framed as unavoidable. Losses are described as necessary. Responsibility is diffused. Accountability fades. Over time, this erodes trust not just in markets, but in institutions themselves. The final truth is simple but uncomfortable. Global debt is sustainable only as long as people believe it is. Ownership determines whose belief matters most and whose does not. When belief finally breaks, it will not do so evenly. Understanding who owns the world liabilities is therefore not an academic exercise. It is a lens through which future instability can be seen clearly. The structure is not hidden. It is normalized. Debt defines modern power. Ownership defines modern security. And the distance between the two continues to widen.